Hello, I'm Elliot Hirschman. Welcome to another chapter in our series of 6-minute seminars. Today's topic is retirement plans for individuals.
An individual retirement account is a trust or custodial account created for the benefit of an individual or his beneficiaries. IRAs can be set up at a bank, mutual fund, life insurance company, or stockbroker. The individual and the institution must enter into a written agreement that meets specific requirements. Traditional IRAs. A traditional IRA is any IRA that is not a Roth IRA or a simple IRA. To set up and contribute to a traditional IRA, the individual must receive taxable compensation during the year. The individual must be under age 70 and one-half at the end of the year. For 2016, the maximum contribution, not counting rollovers, to a traditional IRA is the smaller of $5,500, $6,500 if age 50 or older at the end of the year, or compensation for the year. Spousal IRAs. For 2016, if an individual files a joint return and his taxable compensation is less than his spouse's, the limit on contributions to his IRA for the year is the smaller of $5,500, $6,500 if age 50 or older by year end, or the sum of the individual's and spouse's compensation less contributions for the year made to the spouse's traditional or Roth IRA. Deducting IRA contributions. Taxpayers who are not covered by an employer retirement plan during any part of the year can deduct contributions to their traditional IRA for the year, up to the contribution limit. Under age 50 as of December 31st, 2016, IRA contribution limit is $5,500. Age 50 or older as of December 31st, 2016, IRA contribution limit is $6,500. Trustees' administrative fees that are billed separately and paid in connection with a traditional IRA may be deductible as a miscellaneous itemized deduction on Schedule A. Individuals covered by employer retirement plans. If an individual or his spouse is covered by an employer retirement plan, he may not be able to deduct the full amount of his traditional IRA contributions. The deductible amount begins to decrease, phase out, when the modified adjusted gross income rises above a certain amount and is eliminated altogether when it reaches a higher amount. Married filing jointly with participating spouse, the deduction phases out from $96,000 to $116,000. Married filing jointly with a non-participating spouse, the deduction phases out from $181,000 to $191,000. Non-deductible contributions. Individuals who make non-deductible contributions to their traditional IRA will have basis in the IRA. The basis is the sum of the non-deductible IRA contributions minus any withdrawals or distributions of non-deductible contributions. 401ks should not be rolled over into an IRA account that had non-deductible IRA contributions in the past. Individuals can designate part or all of their traditional IRA contribution as non-deductible. This is done on IRS Form 8606. If the taxpayer did not file a Form 8606 for any year in which a non-deductible IRA contribution was made, the Form 8606 can be filed at any time. There is no statute of limitations. Form 8606 has its own signature line and can be submitted without being attached to Form 1040. A taxpayer who does a Roth IRA conversion can use Form 8606 to reduce the taxable portion of the conversion. Under certain circumstances, a taxpayer who is ineligible for a traditional or Roth IRA contribution may make a non-deductible IRA contribution and then do a Roth conversion. Divorce. If a divorce decree or other written document transfers an interest in a traditional IRA to a spouse, then the interest in the IRA is treated as the recipient's IRA. The transfer is tax-free. An interest in an IRA transferred under a divorce decree or other written document is treated as the recipient's IRA for all purposes, only if it is specifically required by a decree of divorce or a written instrument related to such a decree. Transferring an IRA under a written separation agreement or other court order is not tax-free. Individuals who inherit a traditional IRA from anyone other than their deceased spouse cannot make any contributions to the IRA or roll over any amounts into or out of the inherited IRA. They can make a trustee-to-trustee transfer to a different IRA as long as the IRA into which amounts are moved is set up and maintained in the name of the deceased IRA owner for the individual's benefit as named beneficiary. Individuals who inherit a traditional IRA from their spouses generally have three choices: treat it as their own IRA, roll it over into their IRA, or to the extent it is taxable, into another tax-deferred plan. Do nothing. Then the IRA is treated as an inherited IRA. The deceased owner's basis in the IRA, because of non-deductible contributions, remains with the IRA. Tax credits for IRA contributions. Individuals who make eligible IRA, traditional or Roth, contributions may qualify for the Retirement Savers Credit of up to $1,000, $2,000 if married filing jointly. The non-refundable credit, figured on Form 8880, can offset regular tax and AMT. For 2016 married filing jointly, the credit phases out at $61,000. Qualified individuals must be at least age 18 by the end of the year, not be a full-time student, not be claimed as a dependent on someone else's tax return. Prohibited transactions. Generally, any improper use of an IRA account is a prohibited transaction. Examples include borrowing money from it, selling property to it, receiving unreasonable compensation for managing it, using it as security for a loan, buying property for personal use, present or future, with IRA funds. Roth IRAs. A Roth IRA is an individual retirement plan that, unless specified otherwise, is subject to the rules that apply to a traditional IRA. Significant differences are: contributions are not deductible, distributions are not taxable, owner can contribute after age 70 1/2, required minimum distributions, RMDs, are not required. The Roth IRA contribution limit is reduced when modified adjusted gross income reaches certain levels. The 2016 married filing jointly phase-out range is $184,000 to $194,000. The following chart highlights the major differences between Roth and traditional IRAs. Converting IRAs to Roth IRAs. There are three ways to convert amounts from a traditional IRA to a Roth IRA. The account owner receives a distribution from a traditional IRA and rolls it over to a Roth IRA within 60 days after the distribution. Account owners can direct the trustee of the traditional IRA to transfer an amount from the traditional IRA to the trustee of the Roth IRA. If the trustee of the traditional IRA also maintains the Roth IRA, the account owner can direct the trustee to transfer an amount from the traditional IRA to the Roth IRA. Roth IRA distributions. Qualified Roth IRA distributions are not taxable. A qualified distribution is any Roth IRA distribution that meets both of the following requirements. It is made after the 5-year tax period, beginning with the first tax year for which a contribution was made to a Roth IRA set up for the individual's benefit. The distribution is one of the following: made after the date the account owner reaches 59 1/2 years old, made because the account owner is disabled, made to a beneficiary or to the owner's estate after his death, meets the requirements for the first-time homebuyer exemption.
Thank you for your interest. If you have any questions, feel free to give me a call.